All right, so remember yesterday we were in the fear column, like we were gnawing on our fingernails. Well, we're back in neutral, folks. Here's the deal. This is, of course, a read for the retail crowd. I really believe we've been in neutral for a little bit, but it is interesting, though, because professional investors, they are not afraid, apparently, of this. This is going back to almost 1980. So we're talking about this is the whole entire bond bull market. You had a beautiful trend there. Look at that. That channel was amazing. We're through that channel, folks. And yet, most of the experts on Wall Street see that as a buying opportunity. But I got to tell you something. There is some anxiety out there, and we see it obviously in the options market. So take a look here. Again, a big spike in the put to call ratio. Although some think this is a contrarian signal, actually a buy signal, obviously you can smell there's just some fear out there. Some see opportunity. Either way, we want to know where you can feel the tension, right? This is going to resolve really soon. It's going to break one way or the other. And probably the best question is, is it the resolve of just a handful of stocks that really sets the pace here? I mean, they have escaped Earth's gravity. Some say reality as well. I'm going to bring in Bianco research president, Jim Bianco. And Jim, yesterday you had I like what you put out yesterday about yesterday's session, the anatomy of a good day. NVIDIA was 34% in the move. Tesla was 19% in the move. The so-called Magnificent Seven, 94% of all of the S&P moved yesterday. The rest of the stocks just 6%. Here's the thing. We've been hearing about this all year long. And sometimes I hear experts talk about it. It sounds like sour grapes. Oh, I missed the rally, but it's only 7 stocks. So, I mean, ultimately, do you expect these others to participate, or the fact that this Magnificent Seven will come back to earth and take the rest of the market with it?
Well, you're right that this has been a very concentrated rally, and by some metrics, it's been the most concentrated it's ever been. I think the other 493 stocks have been suffering under the chart you showed a few minutes ago of the breakout of higher yields. The Magnificent Seven companies, the NVIDIAs and the Apples of the world, they don't need banks. They're practically a central bank unto themselves. But the rest of the world does need banks for financial services, and interest rates do matter to them. And I think that they're really struggling in this era of high interest rates that seem to be going higher. So, yeah, the Magnificent Seven can continue to do what they want to do, and they will take the index with it. But if the question is, what about those other stocks?
Right.
I think they're going to need something for like interest rate relief before we're going to really start to see a rally there.
So having said that, right, you were one of the initial folks to coin the term bank walk. And it hasn't really stopped, right? We took our eye off the ball. You keep reminding us with those great charts you like to post. All of a sudden, we're getting these downgrades of these banks over and over again. That bank rally that looked like maybe we were going to, the coast was clear, is completely falling apart. Stocks like Citi are looking really ugly. I mean, we're relying on banks and these companies, which, of course, is going to be tough to borrow money anyway. What's going to happen there? Because the banks look like they're in trouble.
Yeah, the banks aren't out of the woods. Now, to be clear, we're talking about a bank walk. We're talking about people leaving to go to money market funds because they get a higher rate. It's not going to result, or at least we hope it's not going to result, in some kind of a bank failure or anything approaching what March is. But the banks are going to be impaired in their ability to lend and in their ability to offer financial services at a competitive rate to all of their customers, which is the other 493. So that problem is still hanging out over us right now. And you're right. When you look at a stock like Citibank, it's back to the panic lows in March right now. And there's got to be some real concern there as what's going on. Why is this stock performing so poorly?
About a month or so ago, the Bank of Japan said they're going to soften the hard cap they had, that 0.5% cap they had on the 10-year. And a lot of folks said it's not going to make a big deal. Well, it's really starting to take off here. And, of course, they're the largest holder of our debt. The Federal Reserve is letting their assets run off. Where Saudi Arabia is at a 7-year low. China obviously is selling their bonds. I mean, what happens now if the Japanese buyer decide to stay at home and buy just Japanese bonds? Is that one of the reasons our yields are going through the roof?
Boy, you put together a really good list to explain why we're at an 11-year high in the 10-year yield, because you're right. The biggest buyer is the Fed. They're selling. The next biggest buyer is the Japanese. And what they're finding is their rates at home are becoming more competitive, and it might be easier for the Japanese investor to buy Japanese bonds as opposed to buying American bonds, especially because we have to remember they take a big currency risk. They ultimately want their money back in yen, and if they buy U.S. dollars and the yen falls in value by more than the interest rate they're getting, they wind up losing money. And that's been the case a lot for the last couple of years. So as they continue to move back to Japan, our rates go higher. Charles, remember, there's an old adage in the bond market. There are no bad bonds. There's only bad prices. And if we can't find buyers, we'll just keep taking the price down and the yield higher until we do attract buyers. And that seems to be what's happening in the bond market.
I know. It's absolutely amazing. Some amazing things are going on. Jim, we appreciate you being able to walk us through them. Thank you very much, my friend. All right, folks, coming up later.